Now we've done all the elements of accounting from the balance sheet, we move over to element number 4, revenues. So there's 5 elements to remember. The ones from the balance sheet were assets, liabilities, and owners' equity. And now we're looking at the 2 elements that are going to go in the income statement. We're going to start with revenues. So what is a revenue? Well, there's 3 parts of the definition. It is an increase in assets or a decrease in liabilities. So notice this says or, not and. That's going to be important as we go throughout the course. But yeah, either assets go up or liabilities go down. Now, 2, it's got to result in an increase in owner's equity. And 3, it's got to arise in the course of the ordinary activities of the business. That is a lot to remember, and it's very formal. So let's just break it down. What does this first part mean? Well, it means that overall, assets have got to go up, or liabilities can go down. And it just means overall. So let's say you could have one asset go up and another asset go down by the same amount. Yeah, I know an asset went up, but if another one went down by the exact same amount, then overall assets went up by 0. So that would not be revenue. Now, when would a decrease in liabilities happen? That's one we'll save for later, but mostly for now, our revenues are going to be ones that increase assets. But we need to look out for this too. Now, it's got to result in an increase in owner's equity. So the item must make owner's equity go up overall. Now, again, owner's equity can go up and down, okay? But it just needs to go up overall. So as long as it doesn't go up by 0, that doesn't make any sense. That wouldn't be revenue. It's just got to increase owner's equity, okay? So even if it goes up by a lot and down by a little, that's okay. That still makes it go up overall. Now this last bit, what does it mean? Which arises in the course of the ordinary activities of the business. Basically all that's saying is you've got to earn revenues. And that means that a capital contribution is excluded. The owner can't just give the money capital and say that's revenue because you didn't earn it. It's not revenue, it's a separate thing. It's the owners giving equity to the business. So in the real world, at big companies on the share market, they don't really use the word capital contribution, they say capital raising. And when they come out and announce to us that, we're going to raise $100 million in capital, most people think that's a bad sign because it means the business needs money and the owners had to give it money. And it's a bad sign because they didn't earn anything. It's not good news. It's just the owners gave the business money. So we're going to put this in and say revenues must arise in the course of ordinary activities, as in we've got to have earned it. Can't be a capital contribution. So that's the definition. What are some common examples? Well, we've got cash sales or fees. The business sells a good or provides a service and receives cash. But we're also going to say it includes credit sales or fees as well. So the exact same thing, we sell a good or provide a service, it's just that the customer didn't pay on the day, they agree to pay at a later date, e.g. 7 days, 14 days, whatever, and these are going to be called credit terms. Now they're going to be 99% of all the revenues that we do, but there's just a couple of others to look out for during the rest of the course. So one is a commission, and we'll talk about this in more detail later, but basically the business receives a fee from its suppliers for promoting and selling their products. So how would that work? Well, for example, if I'm Rebel Sport, Nike might pay us $10,000. Not like, shouldn't it go the other way? Shouldn't Rebel Sport pay Apple because they bought shoes from them? Yeah, but we're just saying Nike might pay Rebel Sport $10,000 to say, put up big posters in their store saying buy Nike shoes instead of Adidas. Or maybe to encourage the sales staff to recommend Nike shoes. So that's a commission. Different to a sale. You have to actually make a sale for these ones. These ones, the supplier just gives you money for promoting their product. What else have we got? We've got interest revenue. Interest is a bad thing usually. We say that's an expense. Well, this is different. This is where the business earns interest on its investments. So it could be cash or bonds, term deposits. We'll probably see all of these at some point. But when you have an investment, you can earn interest. That's a revenue. And lastly, the business might rent out a property. So it might own a property, it might own more than one property, and it might rent it out to another entity. And that revenue that you receive from doing that, that's a revenue just like any other, and we're going to call that rent revenue.